In corporate boardrooms across Silicon Valley, the stakes of a competition could not be higher. Technology giants are deploying unprecedented sums of capital into a single objective, controlling the artificial intelligence infrastructure that will power global finance for decades to come. This is not a competition that makes headlines in traditional business coverage, but it is reshaping the entire financial system. The tech companies that win this battle will not just be richer, they will effectively own the plumbing of global financial services. Understanding this competition and its implications is essential for anyone who wants to comprehend how technology will reshape money itself. Meta, Amazon, Alphabet, and Microsoft intend to spend as much as $320 billion combined on AI technologies and data center buildouts in 2025, based on comments from their CEOs early this year and throughout earnings calls in the past 2 weeks, with that figure up from $230 billion in total capital expenditures in 2024. Meta, Microsoft, Amazon, and Google parent Alphabet are expecting to spend a cumulative $325 billion in capital expenditures and investments in 2025, driven by a continued commitment to building out artificial intelligence infrastructure, marking a 46% increase from the roughly $223 billion those companies reported spending in 2024. To contextualize these numbers, $325 billion exceeds the total annual government budgets of most countries on Earth. This represents capital deployment at a scale that rivals the Apollo program or the interstate highway system. The companies are racing to build out infrastructure for what they say is virtually limitless demand for AI services. What makes this competition so fierce is that it is not about winning a single market. It is about controlling the foundational infrastructure that every financial institution on Earth will depend upon. The three distinct strategies. The competition between tech giants for financial services is not monolithic. Each company is pursuing a distinct strategic vision, and understanding these differences reveals where control of finance is actually concentrating. Google's current gains of around 62% make it one of the best performing stocks of 2025. With this wild divergence among the biggest of the big tech players directly tied to how well they are faring in artificial intelligence, as in the past 2 years, AI has become an overriding fixation for investors, and Google appears to be the only one that has parlayed its investment into a winning business strategy. Google's strategy is fundamentally different from Microsoft and Amazon. Google doesn't want to be a bank, but it wants to be the platform banks run on, with Google Cloud Services now integral to modern banking architecture from KeyBank to Wells Fargo, with major institutions migrating core systems to Google's environment, lured by promises of agility, cost reduction, and AI-driven insights. Wells Fargo's bank-wide agentic update with Google Cloud represents a commitment to the platform for core financial services operations. Amazon is pursuing a different play entirely. Amazon is by far the biggest spender on capital investments of the group, with its $78 billion for 2024, far eclipsing Microsoft's $56 billion and Alphabet's $53 billion. With Amazon saying in a post-earnings call that its spending of $26.3 billion in its most recent quarter is reasonably representative of its 2025 investment plans, suggesting investments will total roughly $105 billion this year. The vast majority of that CapEx spend is on AI for AWS, Amazon Web Services. AWS is pursuing the cloud infrastructure play, positioning itself as the foundational platform on which financial services operate. AWS notes that financial firms are prioritizing AI for risk and compliance, while also using it to accelerate analysis, reduce costs, and improve accuracy, with AWS arguing that agentic AI is moving financial institutions beyond experimentation and into practical production-ready systems. Microsoft's strategy is more complex. The company is simultaneously pursuing cloud infrastructure through Azure, investing billions in OpenAI, and building specialized financial services solutions. Microsoft is arguing that agentic systems must be treated like digital employees, complete with identities, permissions, and audit trails, with the overarching message that firms that modernize data, embed governance from the start, and align agents with core workflows will be positioned not just to adapt, but to lead the next phase of financial innovation. The infrastructure dominance play. The clearest pattern emerging from this competition is that tech giants are pursuing what strategists call the rails strategy. If they cannot own the money itself, they will own the infrastructure through which money flows. If Apple owns the consumer and Google owns the cloud, Amazon owns the transaction, with infrastructure becoming the new battleground, and from credit to insurance, expecting more non financial platforms to offer financial services. This represents a fundamental shift in how financial control is distributed. Traditional banks own the deposits, control lending relationships, and manage investments. In the future that tech giants are building, they will not own these relationships, but they will own the infrastructure through which these relationships operate. A bank might still be regulated and licensed, but it will run on Google Cloud. Its AI agents will come from Microsoft. Its payment processing will flow through Amazon, and its security will be managed by these tech companies' systems. AWS, Microsoft, and Google Cloud dominate 63% of the market, investing $320 billion in 2025 to expand AI infrastructure and partnerships with financial institutions. This dominant position creates extraordinary leverage. Financial institutions that migrate their core systems to these platforms become dependent on them. Switching costs become prohibitively high. Lock-in dynamics create competitive advantages that compound over decades. The fintech disruption paradox. One of the most fascinating paradoxes in this competition is that tech giants are simultaneously building infrastructure that competes with traditional finance while also providing the infrastructure that traditional finance depends upon. Elon Musk's X has openly declared ambitions to become a financial hub. Meta's MetaPay is integrated across Facebook, Instagram, and WhatsApp, with the age of the super app nearer than we think. While venture deal volume trended flat to down since the heady days of 2021 and early 2022, the rise of AI brought about two significant shifts, with it crowding out other areas of investment. With 62% of all North American startup funding headed toward AI companies in the fourth quarter of 2024, and while deal volumes are down, deal values are up, with the staggering costs of compute needed to drive these AI companies sparking not just high funding rounds, but also solidifying big tech's dominance. This creates an interesting dynamic where traditional venture capitalists can no longer compete with tech giants. OpenAI found its patron in Microsoft, Anthropic followed with Amazon, with both issuing standard investment terms, with only a small part of Microsoft's $10 billion 2023 investment going directly to OpenAI. The cloud wars take the center stage. The competition for cloud dominance is becoming inseparable from the competition for financial services. AWS reported revenue growth in the third quarter of 20% to $33 billion. Microsoft said Azure revenue increased by 40%, while Google's cloud sales rose 34% to $15.15 billion. These growth rates are staggering for companies with such enormous bases. When Microsoft grows Azure at 40%, it is converting traditional enterprise workloads to cloud at unprecedented rates. Financial institutions are at the epicenter of this cloud migration. Eurobank's mainframe integration in partnership with Fairfax Digital Services, EY, and Microsoft, and Metro Bank's commercial lending project with Covecta represent major banks restructuring their entire operations around new AI native architectures. These are not experimental projects. These are production transformations of core financial infrastructure. The regulatory challenge, in a world where big tech and banking is no longer a theory but a timeline, CTOs must decide whether they want to be reactive and disrupted or embedded and essential. The regulatory implications of this tech giant dominance are profound and largely unexamined. When Microsoft, Google, and Amazon control the infrastructure through which financial institutions operate, they effectively have veto power over financial system functionality. If Google Cloud experiences an outage, potentially thousands of banks face disruption. If Microsoft decides to deprioritize certain financial services workloads, institutions have limited alternatives. If Amazon implements new security requirements, the entire financial system must comply. This concentration of infrastructure control in three companies creates systemic risk that regulators are only beginning to grapple with. The spending intensity paradox. Meta and Oracle issued $75 billion in bonds and loans in September and October 2025 alone to fund AI data center buildouts, an amount that reflects the extraordinary capital requirements of AI infrastructure. What is particularly striking is that tech giants are increasingly turning to debt financing rather than relying purely on cash flow. That shift is fueling speculation that AI investments are turning into a game of musical chairs whose financial instruments are reminiscent of the 2008 financial crisis. with about $13.3 billion in asset-backed securities backed by data centers issued across 27 transactions this year, a 55% increase over 2024. This raises a critical question: what happens if the returns on these massive infrastructure investments disappoint? Tech giants are building data centers at speeds that assume virtually unlimited demand. If demand materializes as expected, they win enormously. If demand disappoints, they face massive write-downs and financial distress. The competition between tech giants for control of AI finance will only intensify. AWS Interconnect simplifies multi-cloud connectivity between AWS and other major cloud service providers, starting with Google Cloud, enabling financial institutions to connect trading platforms across AWS and Google Cloud with low latency connectivity to ensure regulatory compliance and minimize execution delays for secure trading. Even as companies compete fiercely, they are also building multi-cloud compatibility, recognizing that no single cloud provider will completely dominate. The future of finance belongs to the company that most effectively combines cloud infrastructure, artificial intelligence capability, regulatory compliance, and financial services partnerships. Based on current trajectories, Google appears to have achieved this combination most effectively, but the competition remains fierce and the outcome is far from certain. What is certain is that the financial system of tomorrow will be fundamentally shaped by decisions made in Silicon Valley boardrooms today, and the tech giants that win this competition will wield unprecedented power over global finance.